Welcome, everyone. It's FOMC Day. Man, hitting up the vertical stream live now, too. So for those of you on Instagram, it is FOMC Day, baby. We're going to jump in. We're going to do our usual share screen. This is the first FOMC meeting in which we are going to do some new testing of the new setup. I'm also going to share with you guys today the beginning of the prediction models that we've been working towards. What I've done so far is shared with you guys static models that show the static look of the market, but the ultimate goal was to develop some conditions and market conditions that we could use to predict how certain stock would react in the future, whether it was a better trade for a stock trade or an options trade. We're going to get through a lot of that upcoming. What up, Vic? How you doing? Hello, my neighbors. How you doing out there? Fancy faces. I see you, girl. And we're going to have a good day today. It's going to be a wild day in the markets, and there's going to be a lot of commentary. I don't expect there to be a rate cut, but we're certainly going to talk about and see what the market leads to. I'm interested in hearing David Kelly from JP Morgan talk. You've listened to the show or watched any of the previous live recordings. You know that I'm a big fan of him. He, again, is a JP Morgan Chase guy. So we're going to see all of that play out in real time. And to give you guys an idea of what this is going to look like, I'm going to have the usual side-by-side. I'm not going to have the smaller screen set up like I did in traditional past views. I'm going to do this while we're live streaming from CNBC. Some of their guests, I think, are really important and valid. And then we're going to wrap up a little bit of the show in between takes and certainly towards the end, talking about some of the things we've seen happen today, which I think are noteworthy. There's been some commentary around Starbucks. There's been some commentary around consumer sentiment we're going to get into. And there's a few things about inflation I want to talk about. And then, of course, there is some new data out from a very relevant survey on tariffs and what that meant for you and me and everyone else. We're going to spend some time on that, too. I think it's going to be really cool. But before we go there, if you've been watching the show for any length of time, and you like it, go over to joinfridays.com. Even if you don't actually subscribe, check them out. Use the code HIGHER if you want to. That being said, let's get in to the markets, shall we? This is our current share screen look right there. I got CNBC. In previous variants, you saw me in a smaller box in the bottom. We're going to do this, and the audio should be working for you.
Tomorrow. Let's bring in Michael Sansatera, Sylvan Capital CIO, who has 6 of the Mag 7 in his top holdings, and they're at each other's throats lately. Michael, welcome. You concerned about this kind of grinding? I hesitate to call it underperformance, but the triple Qs are roughly flat since October.
Yeah, it's sad when flat is underperforming, right? You've seen such a rip in small cap and mid cap that everybody wants all stocks to work all the time. No, it's okay. Earnings and free cash flow are what matters, so they got to let them open their mouths. And I think as we go into earnings, you're going to see a lot of information coming out of the large cap companies, particularly these guys in tech. And as they continue to exceed investors' expectations and their fundamentals are strong, I think the stocks continue to do well. It's okay if they're flat for the first few weeks of the year.
Is this a Gemini problem?
So I'm going to ignore the rest of his commentary because I'm not really impressed so far. With that being said, you do know that we follow the QQQ as the top 100 performing stocks in the tech-focused NASDAQ. We follow that vis-a-vis our market status chart, which is this one. This is not an unexpected result of the day. We have the market in a defensive position, effectively hiding in safety. You've seen this before from us. That's this line here. And what we're really focused on is the market is going to sit in a pause state of circumstances until such time as the FOMC makes their announcement, assuming barring no big revelations, which I don't expect to see. They're going to hyper scrutinize a lot of the rhetoric, but you're not going to see, at least not in my mind, anything meaningful come from today's meeting other than the rhetoric and the comments of other people. A lot of the FOMC's inner turmoil will come out in the later notes of the minutes of the meeting that come out after that. But here we are in the market day. We're in a defensive position. Dows are up slightly. S&P is down slightly. NASDAQ is up a tiny bit, and the Russell is down. The Invesco QQQ is up slightly, again, flat. And this is what he was referencing there. This is part of our market status model, which feeds into other things. Let's go over to, while we're waiting for him to finish up his comments here, let's go into the synthetic volatility index, our proprietary model. We've seen the confidence in the market, when we first rolled this model out, dropped from about 90 down to 86 and then 85, and now it's kind of flatlined around 87. There's been some interesting volatility in the day's trading, but everything else that we're seeing in the markets appears to be what I would call in a very healthy, calm state. We are continuing to be in a calm state, so the people aren't really fearing a lot of risk, and so there isn't any fear the Fed's going to say something that's crazy. There isn't any concern that anything's going to jump out at anyone here. This is more of the markets being calm, waiting to see what the Fed does, even though it's expected, and to see if there's any, inflationary economy language there or concerns. And I'll have a spoiler alert for you right now. One of the things you're going to have to accept is the Fed does not have a GDP mandate. Their mandate are stable prices and employment. Their biggest concern right now is employment. So everything else that we are feeling and seeing right now is not a material factor in how they make their decisions. And if jobs is the primary focus, and you've got a jobs curve which looks kind of like that, where it's been increasing to a 4.4% rate, they're going to stay focused here. Now, keep in mind, while 4.5% is their new target, historically that was 5% because they wanted healthy transitory migration from job to job. So now that that's changed and we're seeing a pivot here, I don't think they're going to look at inflation as being hyper concerning for them at this particular juncture in time. At least that's going to align with their previous narrative. And what we're going to see is a pretty normalized day from the Fed, and I think you're going to see the results as they expect. Let's jump over here back to CNBC for a little bit and see what my man over here is talking about in real time.
These guys. But right now, we're still in those early stages, so it's a land grab. Spend as much as you can, as fast as you can, and make your processing, on a watt per token basis as efficient as possible. Try to get to that maximum, sort of capacity cost ratio as fast as you can, and you'll compete. I don't know if it's one or the other. I think it's probably a mix of the both. You're going to see winners and losers, even in the Mag 7, and even with the guys that are up and coming. I think it's a jump ball still.
All right, and if nothing else, own ASML as you do, and you can sleep well at night, I guess.
Well, if you don't own the memory, you might as well own ASML, right?
Indeed. Michael, thanks very much. Appreciate it for now.
Thanks, Kelly.
I'm Michael Sansatero. Coming up, mortgage rates are breaking 5 straight days of declines and ticking ever so slightly higher today, around 616. We'll get the latest reading on housing demand and talk about what a Fed pause today could mean for the key spring season.
And while they're doing that, let's go into our liquidity and housing affordability index. Here we have that, and I'm going to respond to a little bit of what she said there. So mortgage rate burden continues to be strained. We have a housing market with affordability continuing to be strained. This is not going to change. In her comment, you're seeing mortgage rates rise. Well, we covered this on a previous show. If the Fed is selling $60 billion of bonds into the secondary market and they're focusing largely on the longer end of the curve, the 10-year product, you're going to see a drive up in the 10-year treasuries, and that 10-year treasury is the most impactful to mortgage rates. So because the market has not believed that a rate cut is likely today, I think Chicago Mercantile Exchange has it at effectively a near zero probability as of this morning. What you're really looking at is a market which is saying we've already priced in that nothing's going to change, and those bond prices increasing are going to drive mortgage rates up. Had we have had a larger belief of a material possibility of a rate cut, you probably would have seen mortgage rates tick down. And this is because people who are making loans in the economy, they try to get ahead of that curve and make loans ahead of it to try to swoop up and grab some of that market share. You're not going to see that today. I think the biggest chance of a rate cut we're seeing, according to both Bloomberg's World Interest Rate Probability and Chicago's Mercantile Exchange, is likely going to be June at this point, which is sitting currently around 60-something%. But again, we're so far out from June and that we're 4 or 5 months away from that I expect that number to change a great deal between now and then. And obviously the whole Lisa Cook and Supreme Court situation could bring that down. Let's go over to our liquidity sheet here. The Fed's liquidity policy is continuing to be restrictive. Again, more of our proprietary information here. But effectively, you got a Fed balance sheet which looks flush with cash, but the banks are borrowing heavy on the Fed repo. Treasury accounts are still at a tense position here at a 43, again, using our model. So you've got a net liquidity drain. Effectively, what this is telling you, the viewer, for those of you who are uninitiated, is despite all this extra cash that's flooding the bank's balance sheet, the net effect of them assuming their expenses in this case, which is really what these two are, is that they're draining an incremental amount of liquidity from the system, not adding into it. So the Fed's last conversation about their non-QE, QE of flooding cash into the system is actually not really helping this influx of cash and freeing up the system for, I guess, more buying potential and more consumer sentiment. And to that point, let's talk a little bit about that. We had consumer sentiment come up today, and this is going to be via Instagram because I love sharing on the socials. Let me get over here to our larger vision here, and I'm going to make this smaller. Let's talk a little bit about what we're seeing in consumer sentiment. I think that that's going to be a powerful point of how people feel. And I think what people miss near term is the long-term view. So let's jump into this. This is Yahoo Finance via Instagram. We are going to talk a great deal about this on the show today. So let's get over here and get over to that screen share. There we have it. So consumer sentiment up 2.5 points from December, incremental, but still 21% down year over year. And we're really talking about these numbers here. 56.4 is the index as compared to 71.7 just a year ago. So you have the consumer sentiment effectively feeling significantly worse than they did 1 year ago, even though you've seen some incremental increase. And I would say the incremental increase that you saw month over month from December to now is just because the holidays are over and people feel the pressure off of them. So that slight incremental change is not, in my mind, indicative of a changing consumer landscape. I think you got a problem here. So I think they're still in this wait and see mode as they weigh inflation and weakening jobs market. And I think that might be the new reality for a lot of people, is that the job market as we know it today is changing. Technology is changing. We've covered AI on previous shows, and I think that's going to continue to be the case for the foreseeable future. And expecting us not to have impacts of jobs is kind of nuts. One of the things we're going to talk about on tonight's show, 320, which will be out in about a week from yesterday, is going to be Elon Musk comments in Davos, which we did not cover on our previous Davos episode on AI. It's very limited rhetoric because he doesn't spend a lot of time in Davos. I don't think he likes it there very much. But that being said, he did say some things that I think are really, really, I guess, kind of scary. Number one, that, why save money? Because in a couple of years from now, money as we know it today is going to be effectively useless. And number two, he went on to say that jobs are going to be impacted in a very strange way that I think we should all break down and get into. Let's go back to the countdown to the Fed from CNBC.
Weak right now that the sellers are outnumbering them, and it's not going to help prices any, because if you do have buyers in the market and there's a well-priced home, you're still going to have competition for that.
Exactly.
And most of it's on the higher end.
Yeah, no, or that kind of middle. People are complaining about on Facebook again the other day, just getting outbid all the time. It's a weird market. Diana, thanks. We'll keep an eye on the 10-year after the move today. The Fed decision coming up in about 15 minutes, and up next, Stifel CEO Ron Kruszewski joins us with the issues they're seeing in the labor market and what it could all mean for more rate cuts. We're back right after this.
All right. So the beauty of having our own show is we don't have to watch commercials. Well, some of you on YouTube do. So I apologize. But we got to make money somehow, right? Let's go into Instagram in the chat and see who is out there. What up, everybody? Saeed, I see you. I appreciate you watching. I'm sorry you can't be here. For those of you in the chat, look, we're going to have a real interactive show. This one's going to go about 30 minutes longer than we have historically. And I think that it's important to share and talk about some of the things that we hear from a comments perspective, because again, the sensationalism in today's opinion isn't going to be really meaningful. It's going to really come down to what the rhetoric is around everybody else. So I think analyzing what is said by all the people out there and how they feel is really important. So we're going to spend our focus there. Let's give you guys a teaser of something that I normally don't share ahead of things. But I think that in this particular instance, it's so cool that I wanted to do that. And I apologize, Saeed, if you're watching this. Brother, I didn't have a choice but to do this. This is just kind of what I use for the backdrop to mock stuff up. But this, he's so handsome. Look at his face. He's so cute. Okay, this is going to be what our outcome forecast model looks like. So all the charts that we've shared with you historically, they all feed into this. And the whole goal here ultimately is to be able to tell you with a market conditions, not a price base per stock. We'll look at the stock. Let's clear Side's face here. We'll look at a stock at any given time. We'll date stamp that here so you know exactly when and where that is. And then what we're going to do is we're going to take a look at what is the best type of move next. So is the trade allowed? Yes. The market conditions, the synthetic volatility index, the overall market status will feed into this. What is the best instrument? Is it options or a pure stock play? Is the time horizon short or medium or long term based on what we're seeing? And is the risk of doing so right now elevated or low? Now, these are just placeholders for how the algorithm will ultimately work for us. And then what we have down here is a small breakdown, which will show us the macro market symbol and event breakdown using the same regime we've seen historically, 0 to 100. And if it's got, for example, strong, then the macroeconomics favor a very strong trade. The market economics factors, very strong trade. And this is also going to pull from things like our economic calendar, which you've seen us use before. So we know that if any events are coming up that could move the needle on any of these things, they are risk weighted accordingly. I have called this historically a hedge fund-like model and series of analytics that I want to share with everyone here. And this is going to be something that we're doing free of charge, at least as we beta test it. And what I'm trying to do is feed all of the information we've pulled into this model so that we can make informed decisions. Now, it's not going to recommend stock to you. You'll see what Saeed and I are going to trade in some real-time accounts. Saeed and I talked about this years ago, but I thought just doing it and showing you our trades was useless. Doing this and showing you how hedge funds and other people think about it is different. Now, we are not going to be a hedge fund, at least not right now, because we're not going to solicit anybody's money. We're going to do it with our money and show you what that looks like. And we're going to start off with what we think is a pretty decent amount. I haven't figured out what that's going to be. It's probably going to be around 10 grand or so, just to kind of test the model. And a 20% return would be ideal between now and call it six months from now in a perfect world. So this is where this all goes. And let me show you as a reminder for some people who have not seen the show where exactly some of this information comes from. This is the calendar of events that we pull up here. And the reason why we have this, and the black bars are highlighted to show some of the more important events. Obviously, today's big event is denoted by this box here. It is the FOMC rate decision, which we're going to spend all of our time on today talking about. And that is going to be the most important and impactful part of how this model pulls information in. It's going to take some of these black bars that I know might move the market and feed into that ultimate analysis to give us the conclusions that we know are likely to be risky or not risky. And it's also going to take in some of the things like the sector analysis that we built in. So let's get back over to CNBC for a little bit and see what the conversation is.
More academics thought they should not lower rates at all. Where are you?
Look, I think right now a pause is appropriate. I think that, the Fed's still trying to get to its inflation target. Inflation has not been killed, although the labor market appears to be softening a little bit. So there'll be some room for a rate cut. But today, they should pause. We should get the politics out of the Fed a little bit. There's room for another 50 basis points. Just think, in history, Kelly, if you think inflation plus 1% on real terms, that's about where Fed funds should be. That would indicate about 3.2%, and that's where we should be. So I'm not sure that it's the real big news today. More important is what the 10-year does and what mortgage rates do.
Do you care about the dollar, about gold, silver?
Well, that's two different subjects in some ways, or the same one if you want to combine them. Kelly, the move in gold and silver relative to the S&P 500, it's very rare that you'll see the commodities up that much and equities up that much. And in fact, we just wrote a report that speaks to the level of gold relative to the S&P 500, and it's very high. Gold's 5,200 an ounce, the S&P 7,000.
So let me explain that while he's doing that. So typically speaking, gold has historically been viewed, and I think this is a wrong opinion, as a hedge against inflation. Now we know, looking back at the economic history, that the only true hedge against inflation is to keep investing over time. But traditionally speaking, the stock market starts to do poorly and people go into gold to offset those otherwise economic losses and to hedge against the inflationary pressures they're seeing in recessionary times. You've seen this correlate with recessions for a long time. And now you're seeing people jump into gold, precious metals in a way that I think is really wild. So now you got gold at an all-time high. There's lots of talk about the dollar being useless in a couple of years. We've printed 45% of the U.S. currency in circulation in the last 10 years. So there's been a lot of this comment, which is probably why she brought this up, and it's top of mind for a lot of people. Meanwhile, you've got the S&P at or near all-time highs. You got the Dow in and around the same. So you've got pretty much everything booming, and we are in a clear bubble. That is not to be ignored. Now, the question is what would pop said bubble is, that remains to be seen. And again, anybody who tells you otherwise is lying.
Overall, it's strong. And, I was just in Davos, Kelly, and Secretary of Commerce Ludnick actually uttered the words 6% GDP growth in 2026. Now, I don't know if that's correct or not, but I would say from his lips to the economic god's ears, if that happens, we're going to have a pretty good year.
Well, I think normally we'd go, that's just political talk. But then you see the Atlanta Fed number at 5.5, and you're like, I don't know. I mean, it's not as crazy as it once sounded, I guess we'll say. So you're not worried about inflation? We got to go, but
you know what, Kelly, I am worried because I don't think that inflation has been slayed. The dragon has been slayed. That's what gold might be telling you.
Yeah.
And so there is no more insidious tax on the general population than inflation.
Yeah.
And so we need to make sure that inflation, which was really harmful to the average American since 2020, just go to the grocery, everything is just up. And when people say inflation's coming down, no, the rate of inflation's coming down. Prices are up.
Very smart.
And we have to be very mindful about inflation. No question.
Absolutely. Ron,
you know what? That was a really, really good take and a very, very in touch take. Sometimes you get some of these guys on here who are so materially disconnected to the financial ecosystem because, let's face it, they're wealthier than the average American. But he was actually pretty in touch with the sentiment of Americans. Yeah, he's absolutely right. There has been no disinflation. We are not in a disinflationary economy. So even though inflation is lower, you're still seeing prices rise at a slower cadence than they had historically, but still going up. So much so that I saw an article the other day, which I've got to track down for tonight's show, that putting your money in a savings account is effectively losing money, even at call it a 4% interest rate or a 3.75% interest rate, which I think is probably closer to market today in a high yield account. And when you think about the context of, okay, your money's saving, let's say you're making 4% on your money, but you're in the stock market, you could make more than that, but the prices around you, we look at as inflation as an average number, right? And they're talking about GDP growth, and let's just look at inflation. Inflation, let's just say if it were 2%, that's an average. But if you remember the chart that I showed in the last live, where I showed the things that went up in price and the things that went down in price relative to wages, inflation has gone up across all these products, but TVs are less expensive relative to where they were 10, 15, 20 years ago. And this chart looked from 2000 to 2025 than they are today. But all the things you need to do, the necessities, healthcare, right? Utilities, those are all up a whole hell of a lot. And that drags the average to you, the consumer, up, because we as consumers don't necessarily all spend on the nice to have things, but we all do spend on the need to have things. And I can tell you that inflation there, core inflation there, is really, really impacting everybody. And I know there's pundits who will say that PCE inflation that excludes energy and things of that factor because they're a little more volatile. I don't think they will be moving forward. As a matter of fact, that's probably a good conversation for a podcast at some point in time, is that I think that energy is going to be the du jour demand as these data centers rise. And I don't think it's going to be as volatile. I think it's just going to be a straight increase over time. So I don't know that sensitivity is still there, that where we shouldn't be looking at things like traditional inflation, CPI versus PCE, for example. But that's more of a nerdy debate, which I love because I'm a nerd. Let's take a look at some of the sectors while this is all going on. The housing sensitivity. Housing is up on the day. This could in large part be just a rebound back from what we've seen over the last couple of days. I'm more interested in things like, for example, the banking sector. Credit conditions seem to be slightly impacted by what we have going on here. You're starting to see some of the banks fall off a little tiny bit. We got some breaking news over here. At least that's according to the headline. Let's see what that's about. Something tells me it's going to be anticlimactic. But, oh, look, CNBC has had such breaking news that they're not even going live yet. Let's take a look. This ought to be good.
They're small. The market not expecting a cut. But why it matters to you and your money is not only the future path of rate cuts, Kelly, but Chairman Jerome Powell's first press conference since receiving a grand jury subpoena related to the renovation costs of the Fed's headquarters. Ahead of it, here's how your money and the markets are setting up. And as usual, no big moves.
You aren't the only one with a breaking news banner, bro.
Be down 0.08%. But as you know, Kelly, you just talked about it. We hit 7 7,000 for the first time intraday ever in the S&P 500.
Wow.
A squinch.
All-time high.
Squinch, sorry.
You know, if you pick your, depends on which part of the country you're from. There is a look at the 10-year yield, about 426. That's going to be a level to watch as we hear, not just from the Fed at 2, but of course from the chair. Mortgage rates are above 6% right now, according to Fannie. They're right about 6.16, so these moves will all pan out. The dollar is up fractionally today, but trading near a 4-year low after the president has said, I'm not so sure he cares at this point. It is down 10% over the past year. Flip side of that, benefiting from its weakness, take a look at the commodities. Now, even oil is up 1% at 63, near a 4-month high. The gold rally, of course, continues, crossing 5,300 today for the first time. And aside from all of that, the big test for tech comes after the bell today. Results from Meta and Microsoft, those shares in a holding pattern as well.
Yeah, and with oil, by the way, just watch Middle East, just watch Iran as well. It's not a Fed move.
Not a dollar
There's
story.
some, chatter out there. The president making some comments on social media yesterday. Just watch Iran.
Great point.
Put that in the back of your big brains, everybody.
Let's get to our all-star panel now, as we're just moments away from the Fed's decision.
Come on, David
Here on
Kelly,
set with
baby.
us, David Kelly of JP Morgan, Jeff Kilburg of KKM Financial. We're also joined by Jim Karen of Morgan Stanley and Francis Donald of RBC Capital Markets. Welcome to all of you. Francis, I'll kick it to you first. Ladies first. What are you expecting?
We know the Fed's going to hold today. What we don't know is how they're thinking about inflation. How are they thinking about tariffs? And the elephant in the room, of course, Fed independence. So it's going to look calm on the surface, Kelly, but there's a whole lot going on underneath today.
All right, calm on the surface. David, you agree with that?
Yes, I do. I mean, the Fed's not going to cut rates, but I think we will see one dissent with Stephen Mirren voting again to cut rates. But I think the really interesting part is going to be the press conference. How does Jay Powell continue with this somewhat more aggressive language of 2 weeks ago? And does he make the case that we really don't need to cut rates because rates are already low? And by the way, economy's fine. There's no lack of liquidity. There's no real reason to cut rates here.
We're not cutting rates, Jeff Kilburg, and the S&P 500 intraday, 7,000. Market's the honey badger. It doesn't care.
New all-time highs. But it's interesting, and to David's point, I think the Fed is in a predicament where we're looking for a dovish cut or dovish conversation, or potentially more of a situation. We will see them come in and kind of outline what's to come. And we'll look at personal. Understatement of the year, Sully. It's been personal for quite some time. Is it getting more personal?
Yes, it is. Okay.
And Jim?
Fair. All right. Oh, Jim.
Jimmy there?
Data delays are terrible,
I'm
Jim.
here.
Hi,
sorry,
Jim. How are you? 45 seconds of the Fed. What are your expectations today?
I'm expecting no move. And look, I think the Fed has a lot to think about, including the equity markets and also the value of the dollar and what it's doing to financial conditions. So I think the press conference is going to be much more informative.
David, I agree. I think it's going to be kind of watch the dollar. Normally it's kind of a side story, but right now it's front and center.
No, absolutely, because if the dollar falls some more, that's even more potential inflation pressure. So all it says, Fed doesn't need to be dovish here.
Yeah, and then you also wonder, when do we get the announcement on the new Fed chair? I mean, if I was President Trump, maybe you just kind of want to do it at the same time because that's what you do.
My guy, David Kelly, what a stud. Stud.
Leishman, the Fed's
Let's go.
call on interest rates now.
The Federal Reserve pausing after 3 consecutive cuts, maintaining the rate of 3.5 to 3.75. There were, however, 2 dissents, Governors Waller and Myron. Both dissenting, favoring a 1/4 point cut this time. They kept the language that they used last time to signal a pause, saying that in considering the extent and timing of additional adjustments to the target range, that was what signaled a pause last time, perhaps telegraphing a future pause. There was also a noticeable upgrade to the economy and something of an upgrade to jobs. On the economy, they said it expanded at a solid pace, really marking to market what we know out there in terms of what's been happening with GDP. It had said the economy was expanding at a moderate pace. Job gains, they say, have remained low, but they say unemployment has shown some signs of stabilization. Last time they said it had edged up. They also removed some language that said downside risks to employment have risen. That's gone from the statement. They removed language saying there's been a shift in the balance of risks. That balance of risk was towards downside risk to employment. That's gone right now, too. Inflation, they said, remains somewhat elevated, removing the language that said it has moved up. New voters, Hammock, Logan, Kashkari, and Paulson. I want to say the statement overall suggests the heat has kind of cooled down on both sides of the mandate for the Fed. A little bit more relaxed about inflation, though they're saying it's still elevated, more relaxed on employment, removing that downside risk concern. And just a little bit of trivia here. I'm pretty sure this is right. We're second time in 6 months that 2 governors have dissented, Waller and Bowman in July, now Waller and Myron this time around, though the dissent now is for a quarter, not a 50. Perhaps that's a little bit of coming together. The last time before this past 6 months we had that, guys, was 1993. So still quite a bit of disagreement on the Federal Reserve Market Committee, though perhaps not exactly as much as we've had in the past. Kelly?
If you had to kind of sum it up one more time, Steve, just as what you think the main thrust of this is, or if there's any real surprise for markets, do you think that there is one? There's not much of a market move. I mean, the Dow's down about 47 points.
I think their hair is a little bit less on fire. And I guess I could say this for me. You know, you got 2 sides of the bald head here. You got the 2 mandates out there. A little bit less on fire on the inflation side, a little bit less on fire on the employment side. They're a little bit more like, we're going to wait and see how this all breaks. I reported earlier on your show, Kelly, that there's going to be 2 things: a noticeable break to the downside on employment or an obvious cooling of inflation. Those things, as you note, the Federal Reserve is above the general belief of where neutral is. It's toward the high side of neutral. That's the way Powell has described it. So there's room for them to come down. But coming down now, I think, is going to require an obvious kind of break. It's not going to be a kind of judgment sort of thing at the margin. They'll do it when employment looks like it's if it's weakening very substantially, or they'll do it if it's obvious that inflation is headed towards the target.
Yeah, absolutely. Steve, thanks. And stick around. We'll see you again in just a moment. Let's talk about the reaction. I just quickly, Jeff Kilberger, if you don't mind to jump in here before we get to Rick. Some thoughts on what we're seeing play out. This is almost like the halftime interview when they're heading to the locker rooms. We haven't heard from Powell yet. This is very early in the game still, to be clear. But what do you think of this?
Well, 2 dissents is interesting. It's kind of a stalemate if you think about it, because some folks were looking for it to be more hawkish, potentially more dovish. So this stalemate, I think, bodes well. We are going to see some volatility, but keep in mind the VIX at 16. It's illuminating the fact that we want more out of this press conference. David brought it up earlier. This press conference is going to be tangible, palpable, to see what we can do from now until May, when he supposedly, Fed Chairman Powell, is going to remain in office.
Yeah, so it's kind of stuck. What was stagnant? Is that what you say?
Stalemate. It's an old football term where you're on the goal line, you can't score. So it's like the tush-push. Sully knows about that.
Yeah, I know. Listen, but I would disagree very quickly. Before we get to Rick Santelli in a second, but David Kelly, I would disagree a little bit with my friend Jeff Kilberger.
How dare you disagree with David Kelly?
Gold is soaring. Gold is soaring. Is gold telling us something about the market's risk? Or to your point, Jeff, is it just its own thing, and maybe a VIX at 16 doesn't mean that gold's going to move?
Gold is soaring. That's lots of liquidity. Silver is soaring. That's lots of liquidity. Dollar's coming down. That's inflation threat. And on balance, I think it's a slightly hawkish statement, because they did put a strengthening economy. I mean, they strengthened their economic language. And I'm a little surprised that Waller dissented here. But that's 10-2 in terms of votes. And getting another 4 votes in favor of cutting is going to be really hard here, given the strength of the economy.
Right. And to kind of bring it back to Brian's question, then, everyone who's been bidding up metals and pushing down the dollar and worried about, the new chair and how dovish they might be, this statement takes a bit of a breath on all of that and just says, wait a minute, there's still, maybe not a slam dunk case for a lot more rate cuts.
But I don't think that's happening because of liquidity to come. I think that's because of liquidity that's right now. I mean, there's plenty of beer in the fraternity right now without bringing any more in. But I think that's what that's.
He didn't go to Michigan State.
There's plenty of beer in the fraternity without bringing more in.
We're seeing a lot of movement. And at the end of the day, if you remember going back a couple of years to 1530, Henry VIII, he wasn't happy with the Pope's ruling. So what do? He created his own church.
What are you talking about, my guy?
So will Trump potentially not be happy with who he's going to be a candidate for and appoint himself? I know I'm being a little tongue-in-cheek, a little facetious, but this puts a lot of pressure because rates will not be coming down.
Well, I wonder if Trump will treat the Fed chair like Henry VIII treated his spouses. We'll see what happens.
I didn't go there.
I just did. Rick Santelli's in Chicago. He's got reaction in the bond market. Rick, there's not a huge move in bonds, but I mean, how close are you watching this? It's soon, at some point, announcement for a new Fed chair.
Yeah, I'm obviously very excited to see who he picks. I have my own thoughts on that, but I don't think any of this is really creating any drama, and that really is kind of a story.
Yep.
Whether it's, the criminal investigation, whether it's the back and forth between the administration and the Fed, all of that gives good fodder for newspapers and websites, but it's not showing up in markets, and it certainly doesn't seem to show up in any of the underpinnings of this meeting or the statement. Two-day charts give you lots of information here, Brian. Look at a two-day of 2-year and realize that we are dabbling a lot of action today under yesterday's low yields. And we were at 358 before the statement was read. We moved down about a basis point. We moved up about a basis point. And guess where we're at? Right at 358. If you look at a two-day of 10s, completely different. Yields are doing a lot of work above yesterday's high yields. Once again, that steepening effect, stickiness of the long end. It was basically right around 425.5, went down a little bit, went up a little bit. It's actually net a little bit higher. Maybe the most interesting trade of all is the dollar index. Dollar index has been moving up a little bit, and right now, should it close here, it's actually back above what was the 2025 low close, so it's got some buoyancy. We were discussing earlier, anybody who looks at a dollar index chart past 2003 sees the amount of time over 100 is minimal, so we shouldn't make a big deal about this, but maybe the biggest story is the normalization of all the infractions central banks did for about 7 to 8 years right before COVID hit, and then they really went off the rails with things like QE4. So I think the bottom line to this discussion and questions to Chairman Powell ought to be, why is gold moving up and are central banks largely responsible?
That's why I asked our good friend David Kelly that exact first question. Rick Santelli, thank you very much. I want to go to my friend Francis Donald of RBC, because I love your view, because we're talking about exchange rates. You don't just talk about exchange rates, you live exchange rates, because you're working for the large.
I don't love her view, so we're gonna take a pause on her for a little bit, let them talk for a little bit in the background. I'll leave this up in terms. So there's some things I just disagree with right out the gate. Let's be honest with what I mean by that. Number one, I don't think the jobs market is stabilizing. I think that's a convenient narrative for the FOMC to push to hedge their bets. So what you know is you've got a very upset president, executive branch. You have today's treasuries here. I think, again, this is going to continue to drive, these things here are going to continue to drive pressure upward on mortgage rates. You're not seeing a rate cut expectation. You didn't see rates drop ahead of this. You saw rates stay relatively flat. I think the biggest thing moving this is what's happening in Japan in their bond market and our own treasury selling bonds into the market. The gold conversation is one to be had, and I do think going off the gold standard does deserve some, I guess, pretty hard review. We went off gold standard in 1971, and doing so has had reverberating impacts to not only our economy, but for currency in general. And this is the whole fiat currency argument that is a much longer dialogue than today. But suffice to say, I disagree wholeheartedly with the idea that jobs are stable. As a matter of fact, I think jobs are anything but stable. I think we're on the beginning of a tidal wave. And what we're going to talk about on tonight's episode 320 of the podcast is going to be some of Elon Musk's comments around the job market and the idea that he's saying AI, AGI, artificial general intelligence, is likely to happen by the end of this year, if not definitely next year. And if that does happen and we can deploy this and all this CapEx actually brings efficiency and value, I think you're going to have a slump of jobs like we've never seen before. So to calling it, quote, stable right now based on data looking backward the way that we do this is foolish and unwise, right? It's like me driving towards a cliff saying, you know what, this car drives really well. Well, in about 5 minutes when I hit that cliff, this car ain't going to drive at all anymore. And that's just my humble perspective. I do love David Kelly and the alcohol examples here. So what we're going to get next is the FOMC press conference. You're going to see Jerome walk in. He's going to read off of his statement that he's read many, many, many times before. It's going to have slight micro edits. One of the things we do on the show, and I will do on tonight's podcast, released next week, is compare the notes from what was in the last episode, last press conference PDF versus this PDF. And you'll see the small incremental changes they make to the words. The meat and potatoes, the real value that everybody keeps alluding to because we kind of knew that there wasn't going to be a rate cut today, is going to come from that press conference in the dialogue. That's where a lot of my smart assness comes out. That's where a lot of what we're going to listen to comes out. We'll see who asks questions and what. Now, don't get me wrong. I don't mind these guys. I love David Kelly, as you've probably seen during this. But their opinion here is just like ours. They're watching. They're observing. They have the same level of analytics and data that we have. And they're going to talk a lot about what's coming up after the press conference, and that's some big earnings releases from people like Meta here. While we're waiting, let's jump into Steve Leisman.
I'm having a little trouble seeing this. You know, Kelly, usually between you and me, there's a piece of paper between our different views here, but I'm having a little trouble seeing this as hawkish for the following reason.
Agreed.
It was the prior guest who made the correct statement, actually used the same phrase I used, which was marking to market. The Fed could not avoid the GDP numbers. It could not avoid the data numbers such as we have them. Obviously, we don't have complete inflation numbers. So I think the people who I talk to who follow the Fed very closely were fully expecting an upgrade to the economy, a downgrade to the risk from unemployment, and a signal that maybe we're going to pause at least one more time. It's precisely how the market was priced going in. So I'm not really seeing this as hawkish. I'm seeing this perhaps as a return to neutral. Now, if you were on the bus that was hoping for rate cuts all the way from now until the end of eternity, then you're disappointed. But I think a lot of people got exactly what they were expecting today.
Jim Karen is standing by. Jim, you agree with that?
So I think we need a different perspective to think about this, right? We have to think about this through the lens of the Fed. The Fed thinks about things through financial conditions, right? Which is short-term rates, intermediate-term rates, the equity markets, credit spreads, and the value of the dollar. Right now, what the Fed is observing is that the markets are easing for them. The markets are easing all around them. So now the Fed has to go back and think and rewind this and think about this in reverse order. What should the Fed do at this point? So right now, the whole conversation is about should the Fed ease?
All right, so look, his own analysis calls for one rate cut this year. JP Morgan Chase, who David Kelly works for, no rate cuts this year, one rate increase next year. To start this show off, we just heard about the S&P 500 hitting 7,000 for the first time ever in history, all-time high, and then coming back down to just under that. So what's the motivation for the Fed to cut rates and move things along? If we're at all-time highs there, all-time highs in housing, all-time highs in gold, the question remains to be seen, like, why would they need to incentivize the economy by cutting rates and sparking things? And if they truly do believe that jobs are stable, then the best thing to do here with the data is to hold rates, which is why I think that no one is really surprised by what we saw.
Credit spreads in the equity markets. Lower interest rates, short-term and long-term, right? Those rates have stayed relatively low. That's easier conditions. A weaker dollar helps with exports, so trade deficits, things like that. That in corporations and profits, that's an easing of financial conditions.
You mean the moves broadly this month, not this moves in the last 5 minutes?
Yeah, exactly right. Yeah, the moves that's going on. This is what the Fed is basically judging their policy actions on. Credit spreads are tight, so therefore the cost of capital is relatively low, and equity markets continue to go higher or at least stay relatively strong. So the way that the Fed is operating, and again, they always operate through this lens of financial conditions, their policy needs to be reflected in what's happening in markets. Yeah. So I would read this from the Fed's perspective is that their policy is relative to what's happening in markets is pretty easy. Now, they could still cut one more time, but it's dependent on the labor market.
Maybe they will. David, we're having a great discussion, okay? Very smart discussion. I want to pull it back a little bit because you know what question, Kelly, you probably get, I get. I know, Kilberg, you're down in Nashville. Hopefully the power will come back on soon for all your friends. Is winter rates going to go down meaningfully, David, because people want to buy homes? They want mortgage rates to come down. 10-year yield is up today. Mortgage rates have just stubbornly kind of stuck around.
That's right.
Like a bad rash.
And I'll explain why.
I'm sure if you could sort of layman it out where basically when will people out there listening and watching right now who, you know, they don't trade bonds for a living, but they may want to buy a home, will they see relief anytime soon?
The mortgage rates are not high. The problem that we have in housing is that mortgage rates are way too low for a decade. That caused home prices to shoot up to levels which can't be afforded with normal mortgage rates. Now, the problem is to get to really low mortgage rates, you're going to have really low long-term interest rates. The only way you're going to do that...
That's what the president wants, though. Yeah, that's what he keeps talking about.
Be careful what you wish for.
And he's going to put somebody in office that's going to basically try to do what he thinks.
They can do that on short rates, but the only way to get long rates down is you're going to have to crush inflation and crush the economy.
That's right.
Or Operation Twist, again.
No, it's still not going to work. Unless you have a recession, you're not going to get those long rates down significantly.
What a stud David Kelly is.
Just pursuant to this discussion, we've seen some movement in the Fed chair odds. I just want to show this on the screen for a second. Kalshi has now put Waller, I think, given him a little bit of a pop after this. So here, Readers dropped down to about 30. Now, he's still on top, 36% chance. There's Walsh at 27. There's Waller at 14. Hassett at 7. So Readers odds dropped more than...
So of note today, Waller and Myron. Myron has always been somebody who wanted to push hawkish or cut rates down, and he's been aggressive on that. He's dissented every meeting since he's joined. President appointed him. He's part of the new regime, if you will. Waller joining to me signals that he wants to be in the running. So he dissented to agree with Myron to have a better probability of being named head of the FOMC. You cannot ignore that political spin. I think Kalshi captured that very well. We also have that in our own predictions market here, powered by Poly Markets. Take a look down there as that scrolls by. And actually, while I'm here, interesting to note the speed with which CNBC's like fly by there. I mean, how is anybody supposed to look at the markets here? We do this with pictures and a lot slower cadence. Come on, CNBC. Be better. No one can read that. No one's getting any value out of that. Anyway, so yes, David Kelly is 100% right that we have this weird human behavioral economics impact where we want to get rates down. Anything traditionally below 8% really is considered to be a low mortgage rate. Our mortgage rates today are low, even though they're around 6% for a 30-year fixed mortgage. I know that sounds wildly disconnected to the plight of most Americans who have an affordability crisis on their hands. Frankly, in my mind, that it's been unprecedented. But the reality is you need a combination of things to happen. We've talked about this in the show before, and that is going to be, number one, wages need to go up. Number two, home prices need to come down. And number three, rates need to stay where they're at or possibly decrease. And whether we like it or not, the fact of the matter is that if you look at the overall condition of banks, they're not doing badly. They're doing just fine. So let's go over to the affordability index here. And oops, that's weird. That should have not have happened. Oh, there we go. I got to fix that. All right, so if you go over to the affordability index here, the homeowners are strained. What this really means here is that the mortgage rate pressure is the easiest fix near term, but that doesn't solve the problem because this will just ignite the home price issue again. And then this problem right here, you can't keep lowering rates. That's like saying we can keep our debt increasing over time and just ignoring it. Well, sooner or later, that breaks the same way this breaks. So lowering rates does not solve the housing market issue long term. It only solves it near term. And while I'm sure that many people can use that, we still have to figure out the back end of things, which is going to be wage increasing and home pricing coming down incrementally, because it has to be a combination of all these things. One solution alone is not going to be enough. I did find the 401k positioning by the White House tapping into that to be somewhat helpful, but also disconnected to where most Americans are. Let's get back into CNBC and David Kelly.
Tools.
Yeah.
They don't have to cut interest rates to achieve the goal. The messaging from the White House has been over the top about housing affordability, bring that long end of the curve. So I talked about Operation Twist, Kelly, but if you bring in Operation Twist and you bring the duration of the portfolio longer, you bring down those interest rates, that's going to accomplish the goal, if not even better than the outcome of just cutting 25 bips.
Okay,
No,
okay,
no.
hold on.
Totally
That's a
disagree.
Great point, Chubby Checker. I love the twist reference. Okay. Francis Donald.
Chubby. I was like,
because Chubby Checker.
That's a little true. That's a little true.
No, you're husky. It's a different.
Bro, you're old. You can't use references like that anymore.
Good, brother. Francis Donald, help us out here, because here's where the confusion is. Jim Bianco, bond market guy, super smart guy, posted this tweet basically showing this idea of a K-shaped economy, right? Where consumer sentiment goes
That's
down,
real.
but the market goes up. There's the tweet. Orange line, consumer. Blue line is stocks. We have consumer confidence at a 12-year low and American stocks mostly at an all-time high. From an economic perspective, any reason why this is happening?
What is that a stupid question or
There's
what?
a long list of reasons why we see all sorts of Ks in the U.S. economy. But as we're having this discussion, Brian, I just need to take a big step back. Next month, we're going to celebrate the 5-year anniversary of inflation above 2% in this U.S. economy. And we don't even talk about that anymore. We got a Fed that is maintaining a...
We're going to celebrate the 5-year anniversary? What the actual shit is she? No. That is a terrible thing, number one. Number two, this K-shaped economy is a problem, and it comes down to home prices, right? I mean, if we have all-time unaffordability and more Americans cannot buy homes today than they ever did before, the average age of a home buyer is now 40 years old, okay? People can't build their greatest source of net worth, which historically has been the equity, the appreciation they get in their home over time. So to sit here and to, I guess, celebrate the ideology of this is not only nonsensical, but it's moronic.
But how then do we break it? How do we break inflation? Because I think you're exactly right. I think everybody watching, they were hearing about the Fed. They don't care. You know what they're mad about? They're mad that a burger is $20 when 4 years ago it was $12.
Yeah.
Right? And next year it'll be 21. It won't be 30, but it's going to keep going up. Yeah. How do we break, and the electricity bills, to your point,
pay
and who can
people
afford
more
loans?
money.
Okay? So how do we break that without breaking the economy?
There's a whole range of reasons why prices are higher and have been persistently, and a lot of them are supply side issues. Tariffs are impacting goods inflation, maybe not to the degree that many expected, but they are lifting goods. We have droughts that are happening in South America.
Not to the degree that people expected. Really? You want to go here with me? Okay, look, I like her, so I'm not trying to be disrespectful, but tariffs are impacting people, but not as much as expected. Really? Okay. Let's have this conversation. Let's do this. You know, every once in a while, Chris has got to play the bad guy, and well, I'm going to do that right now. What I'm going to do is I'm going to show you how that is a complete not accurate statement. This is a study that came out. American consumers are bearing 96% of the tariff costs. Study finds American consumers are overwhelmingly footing the tariff bill. New research from Germany's Kiel Institute finds that U.S. tariffs have worked less like a tax on foreign exporters and much like a consumption tax on Americans. After analyzing $4 trillion in trade flows from January 2024 to November 2025, researchers estimate that U.S. consumers and importers absorbed about 96% of tariff costs. So I vehemently disagree with her stance on less than people expected and how she's approaching that. And you know what? That's fine. I get it. It's her perspective. I respect her a great deal, but that bothers me.
You're going to have the Democrats are going to take over the House, I think. And if they do, more fiscal stimulus is gone. Because right now we're just about to have a boatload of fiscal stimulus through income tax refunds. We're probably going to get a second dose through a tariff rebate check. But that gravy chain comes to an end.
Maybe Powell should just say that. If they have to skate, if they're going to act with 18-month lags with monetary policy or whatever, then maybe 27 anticipated weakness does matter.
Well, yeah, but there's a lot of...
And let's talk about that for a little bit too, because this is going to be a problem. We boosted the economy with stimmy checks, right? And those stimulus checks during the COVID-era pandemic led to more cash being in reserve accounts of most Americans. It led to excess consumer spending. It propped up GDP. It led to this inflationary economy in part to where we are today. Now we're going to pass on this inflationary benefit to the consumer. You know what the nutty part about this is we just read that 96% of the tariffs were passed on to you, to me, to everybody else. And now we're going to get checks back from the government. Well, guess what? That's just us paying ourselves back. You know what most Americans would like? They would like less stress every single day of their life, and instead of getting a refund of some of the money they overpaid on tariffs because our government, stepped in and did something they fully did not understand from a financial perspective. I understand. But what we basically did as citizens, and I'm just assuming they give all the money back vis-a-vis these refunds, which I don't believe that to be the case, but let's just assume best case scenario for the government that's true. Here's the problem. They got a tax-free loan from American citizens to the tune of billions of dollars, and now they're going to give us some money back and make us feel all warm and fuzzy because we're getting a $4,000 tax refund or a $2,000 tax refund. Again, no disrespect to anybody here. I don't think this was done as intentionally, but the end of the day is we as consumers pay more for product because it costs us more because companies pass that on. Companies make the same, if not more money than they ever have before. We know they're paying less dividends. That's a fact. And guess what? We get a we get a refund waved in front of us like it's a miracle. But at the end of the day, that's just our money coming back to us.
And of course, this raises a whole host of questions around his tone after the DOJ investigation and all the rest of it. I'll bring it to you live the moment it begins, right after this.
All right. And I should pause here to say, I know that's aggressive, and I know that that's a pretty harsh take, but it's a substantiated take. It's one we are going to talk about on tonight's show. Next Tuesday, episode 320 of the Higher Standard Podcast. Saeed and I are going to break this down, and we're going to walk through the logistics of exactly why I feel that way and why it's actually real. I think we are getting a narrative spun to us that's very convenient and easy to believe because the totality of the circumstances are such that you see one thing happen, and then several months, if not a year later, you see something else happen, and you don't realize those are the same things. What's the expression? The best magic tricks are planned so far out that you just don't see them. Well, this magic trick of a tax refund to make us feel good in the middle of a midterm election cycle where Republicans clearly want to maintain their position. And again, Not knocking them. That's just, you have to understand the motivation. And I'm not giving you my political sway one way or the other, but I am telling you that these are factors we cannot ignore as a populace, as a people. And if we think this is going to change the economy, we're lying to ourselves too, because that's not actually going to help us in any meaningful material way. We got a little bit of time before the press conference kicks off here. Let's go to the chats. Let's see what we got here. I'm going to scroll into the Restream chat. This pulls everybody in. The peak higher standard, loving the fact checking. Yeah, man. Yeah. I got to be honest with you. I don't like doing that per se, but a lot of times you get these talking heads that are so ingratiated into their niche. And she's a very bright person. She's very talented. I'm not knocking her. She's articulate. She's sharp. But every once in a while, people get so bogged down with their positions that it's really difficult to have a degree of confidence in everything they say. And in this case, I've been watching all these things like a hawk. I've got more time now than ever before to watch and see how these shenanigans approach. So the tariffs, shenanigans right there. The tax refund, shenanigans. The idea of the consumer sentiment, also shenanigans. We're not going to do that, and we're going to go through that in broad detail. And thank you for commenting. It makes me feel really good to know that people out here actually care what I say, because every once in a while I'm like, is anybody still listening to this? All right, let's also take a look at the Instagram chat. I see you out there, Instagram. A lot of people come in and they leave, they dip their toes in. I understand this is not the best format for Instagram. If you're seeing this on Instagram, you're getting a little tiny box on your vertical phone. It isn't the best visual display. If you want the full experience, go over to X, go over to LinkedIn, or go over to YouTube. TikTok no longer allows us to stream because we're, quote, too produced. Believe it or not, that's a real thing. That being said, let's get ready to go into the next phase. Before we do that, let's take a quick check of the market status. Currently, we have a market that is continuing to be in a defensive position, hiding in safety. You got the Dow, S&P, NASDAQ, Russell, and QQQ all relatively flat on the day. Not a whole lot of emotions in what we're seeing right now. I do think that the S&P hitting all-time high is kind of nuts. And you saw the SPY here. We trade off the ETF, so we don't look at the actual indices for that reason. Let's jump back into CNBC. I think the press conference is going to kick off here any minute. This, for those of you who don't recall, is going to be a very, very, very important tone set by the FOMC head, Jerome Powell, and we are going to do a full breakdown on it later this evening as well. So let's go.
Month of January. And will he make it to May of 2026? Will President Trump appoint someone differently? So there's a lot going into this press conference. Couple that with we are seeing 3 of the Mag 7 reporting afterwards. It feels very coiled here, and that's why we're seeing a bit of a stalemate. The word of the day, stalemate.
Okay, but hold on. We're entering year 4 of a bull market. The average return on a bull market in the 4th year after double-digit gains is 14.7%. Doesn't mean we're going to get those gains, but his history is on your side. So the 5th time, by the way, in 100 years, we might have 4 double-digit returns in a row. Is there anything you've heard from
4 times in 100 years? We just hit an all-time market high in one indices. Gold's at all-time high. Housing's at all-time high. Do I have to be the guy that says, hey, maybe we should back off the sauce a little bit and stop doing so much of the blow? I mean, do I got to be that guy?
Attribute that to a lot of the Mag 7 profit taking we saw at the end of 2025, Sully. But what's interesting in this broadening, 65% of S&P 500 stocks thus far in earnings season are outperforming. So I get excited about the profits. We talk about profits being a more important input to the economy. But yes, what Fed Chairman Powell says or what President Trump says about who's coming in to potentially play the part that he wants of lower interest rates is critically important.
Anybody better for the markets? Reader, Walsh, Waller?
I think Rick Reader is a practitioner. He understands it. Obviously, coming out of BlackRock, he's the guru. So having
okay, a guy from BlackRock coming in, yeah, he's good, and Rick Reader is talented. But let's be honest, this is basically you've thrown in a bunch of people who all want the job into the Coliseum, and they're all playing the gladiator role, trying to go after each other. I frankly feel that's why Waller dissented right now. He's like, fuck it, it's not going to change the vote. So Myron's going to dissent. I'm going to dissent. Let's just see what happens. And maybe Trump thinks that I'm a good guy for this job. Let's go, Jerome.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization. and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak.
Yeah, no shit.
The temporary shutdown of the federal government likely weighed on economic activity last quarter,
you think?
But these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Q&A, baby. Let's go.
Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and
that's your first question
in response to the Secretary's criticism?
So let me start with I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that case is perhaps the most important legal case in the Fed's 113-year history.
Yeah, I agree.
And as I thought about it, I thought might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so.
He loves Volcker.
So
you knew he was going to cite
precedented,
Volcker.
And I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on.
Good for you.
The job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And
I don't like.
What's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but
Yeah,
some
I
signs
don't
of
see that, dude.
stabilization. There are also some signs of continued cooling.
Yep.
And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Where's Steve Leisman at?
The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the
Why are we
video
doing
statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
Bro.
So today I'm simply going to refer you to the statement that I made on January 11. I'm not
Obviously.
going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. But I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
They haven't.
nothing
You know
for you
that.
on that today.
What are you doing, dude? Like, why is the Wall Street Journal going down a political narrative to try to catch? So stupid.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor
What
of
the fuck
the
are we
Federal
doing?
Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today.
Why are we
That either.
trying to start a fight between him and the president?
Why would you want to leave it all under the circumstances?
Oh, he's not going to answer that, dude.
Again.
He's not. What the
I don't want to get into this. It's not
fuck is
something
going
I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
This is nuts.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the
That's
volatility
not his job.
we've seen this week?
What the fuck is going on in that room?
Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
I mean, what's your view on the market movements? I mean, what do you think behind them? Is
He's
it asset
not going
managers
to answer that
diversifying? Is
question.
it-
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really,
Are
the
they
Treasury
insane?
Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Please put Steve Leisman on the mic.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market and the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Oh, an economic question that he can answer.
First of all, if you look at the incoming data since the last meeting,
Jesus.
clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting, we're evidence of stabilization. So it's overall a stronger forecast.
Evidence,
really,
of stabilization.
If that's your question.
Not actual stabilization.
I'm not sure I answered
just
your
to be
question.
clear.
But in terms of timing or pacing of any additional easing,
So we haven't made. What we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate.
Is everybody
And we'll
here a
continue to make our
first-timer at the
decisions meeting by
FOMC
meeting,
press conference? What the hell's
based on
going
the
on?
incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings.
Because he wouldn't tell you if it did.
The economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve Leisman, come on, baby.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you.
See, he gets it.
You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral?
Good question.
And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. Is that, you had a follow-up?
I get what you're saying. But, some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the S&P from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
To wait and see. That's what he's saying. We're well positioned to wait and see. And unless something meaningful happens,
Bloomberg News.
Don't expect
to
a rate
what
cut.
extent did the committee discuss the possibility of cutting at this meeting or in
Great
March?
question.
And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
Very good question.
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented.
Waller and Meyer.
Committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
No.
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and you know, that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you
to me, to the consumer,
were to take that out, you'd get, and you would, I mean, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's
Actually,
what's going on.
He's probably not wrong.
The expectation
that's
is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't think
I don't have anything for you on that.
Yeah.
That will depend on Congress's actions and things I can't speculate on.
Yeah, good answer. Move on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And you know, we think our policy's in a good place. I've just discussed reasons why we might change our policy, and you know, we'll just have to see how the data lead us.
I'm wondering, a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. You know, they were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are, you know, very consistent with 2% inflation over time. So expectations have been solid, and they reflect, you know, confidence in the return to 2% inflation.
It's a good answer.
Andrew.
Good answer.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
That's actually a good question.
You know, we haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals.
I legitimately don't think it's better.
Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, you know, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table,
laid off
but it isn't anybody's base case right
today?
now. Anybody's base
really?
case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right
it
now.
is J.P. Morgan's base case. So, point of contention. Yeah.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Surprising comment
Does it
on that.
reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
No.
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
Is he going to answer that?
Really, the point of independence is not to protect policymakers or anything like that.
Get
It just
Jerome.
is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. Just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially, the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like
they just can't make ends meet after 5 years of rising prices. What is that discussion like?
So a couple things. One, there's something to it in that we know that
You think?
higher income households that tend to own real estate and tend to own stocks, securities.
Rich people
and
do.
those assets have been going up in value, and increases in wealth do support spending over time. So
because they have more money to
that's
spend.
clearly a part of the story.
Because they're rich.
We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and
you gonna make me do this, brother?
That is a reality of what we're seeing. They're still consuming. But
look at all the consumer
they're
staples.
feeling it in a different way. I would say more broadly.
It's a consumer health chart,
on
Chief.
affordability. We have a vast network through the Reserve Banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because our job is one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control.
You mean everybody who's not
frankly,
rich?
Finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment, and trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And
you don't
it may
see
not all happen
rising
immediately,
wage,
but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different. Is it going to be different? And we don't know.
You
and
do
we may,
know,
in any
dude.
case, see in the short term.
This is not the
jobs
internet
that are being
boom,
eliminated by the capabilities of AI. We may see that.
So materially disconnected
we just
to
don't know
reality.
what the overall effect is going to be. So how to think about it in macroeconomic terms?
You want to know
it's
how
very
it's going to
hard.
be?
We
People
can
will
look
be
at the
out of
aggregate
jobs,
data.
dude.
We can analyze, for example, the
whole
there is
point
some
of the
connection, it
CapEx
appears,
spend.
between the low
Shut up, let
hiring
him
rate
talk.
for
I know.
recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise.
Maybe you need
but
AI.
we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
This is so. He's in the box, but he doesn't take.
Thank you, Chair Powell.
the
Beatty
step
from
to
AFP News
acknowledge
Agency.
what AI is for.
You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
Good question.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, so no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see, for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But, we'll be able to see whether things are moving in that direction. I think, we will be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is, a lot of it is around energy, oil. And so far we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is. You need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of, certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Did he just laugh?
Honestly, I'd say a couple of things. One is
oh, be careful, dude.
stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with.
Classy.
And when you meet Fed staff,
classy.
And not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Class, class, class.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late.
Already asked,
and I'm wondering
brother.
how much attention, if any, you pay to those moves, and
He's
what
not the
message
Treasury Secretary.
you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Last question, baby. Bring it in, Nicole. Come on.
Hi, Nicole Goodkind Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI.
Yeah.
How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why.
What?
Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections. And that's the basis for how we think about the economy. So the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy.
AI
That's
is
just the way it works.
unprecedented.
However,
Your
the
historical
structure of the
variables do not
macroeconomy
matter.
is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning. It was not in the model.
It had happened
A
before.
trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments
Had to get a
that
package.
raise potential output, some kind of technological revolution, like happened in the 90s here, and like maybe happening now with AI. We're all over that, and everyone studies those periods, and we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not. No one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years.
Okay.
It long
I
predates
hear
the
you,
current
Jerome.
situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of
the
using better
unemployment
models,
ramifications
bring them
are
on.
not.
Where are they? We'll
They
take
are
them.
not.
But I think, we
You've
certainly
got Elon
are
Musk
in
saying people are not
contact
going
with
to be
anybody who
jobless.
does economic modeling, and we're always looking to do better at that. But that's how I think about that.
All right, political.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these? What data or channels are most critical to follow this in real time?
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs.
Not quite.
At the beginning, it was very
it.
much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Oh, God. I'm going to prove this theory wrong.
Okay.
Right after this.
Thank you very much.
All right, that was the Fed chair following no move on interest rates as expected.
Oh, God.
Chair Powell saying the economy is on firm footing, consumer spending resilient, conditions appear to be stabilizing in the labor market, and that the Fed is, quote, well-positioned to determine our next move on rates. I thought it was notable that the very first question of that news conference was on why he attended the Lisa Cook hearing.
It was stupid.
Before the Supreme
wasn't
Court.
notable.
He said he did so.
But let's skip the foreplay of the post wrap up here. Okay, there are some things that he said that are just, frankly, materially disconnected to reality. Okay, and it's infuriating. If you know the government's planning on providing extra tax returns back to the U.S. citizens, and we know that to be true, this is not speculation on my part, that is real. And you know that tariffs have been passed through. 96% of them, which we have talked about, we have evidence of, that is real, okay? I covered that earlier in the show if you guys tuned in late. You know we're just getting our money back, but you also know we're getting our money back at a lump sum, which you saw what happened during the stimmy checks. You saw what happened to inflation. You ignoring that is looking down the barrel of a shotgun and saying, oh, hey, inflation seems to be in line now. It's not going to be, okay? It's not going to be. If the government hands out those stimmies, it's not going to be. That's a problem, number one. Number two, it is very clear that you're relating AI technology, a once in human history changing of events, okay? Tantamount to the Industrial Revolution in some ways, the Silicon Revolution, if you want to call it that. This is not the internet, all right? This is a completely different technology. The whole point of this is artificial general intelligence, which Elon Musk, somebody who's probably more sophisticated than you and the other FOMC heads, has already said if it doesn't happen this year, it's going to happen by 2027. AGI will displace American workers. And yes, you can argue that all this technology in the past historically has displaced workers but created other jobs. Okay, fine. You know what? If something coming along is meaningfully going to displace workers and we have to hope that new jobs will be created, shouldn't we be a little bit more cautious around jobs, around employment? I mean, am I insane? Maybe. This was a very interesting start to the conversation. Lisa Cook's legal case may be the most important in Federal Reserve history. Jerome Bang Bang Powell said in his comments, and frankly, I don't disagree with him. What he's saying is that Fed independence is on the table. If this case gets overturned, the entire Fed can and will likely be controlled by the rhetoric that is put in place by the current administration. Love it or hate it, those are the facts. You can argue one way or the other. I still think it's important to note. Let's go ahead and look at a recap of the final thoughts from today. Here you have some recap from the FOMC, the takeaways. Number one, Lisa Cook case is absolutely important. Number two, mainstream media loves to provoke a fight. Those questions in the beginning were completely stupid, and we all knew that he wasn't going to answer it. Those were solely for sound bites. Number three, the FOMC does not understand AI. It is equating it to things we've seen in the past. It is not like the things we have seen in the past, and to estimate it or assume that it is that is foolish and naive. That will come back to bite them in the butt. There are no rate cuts on the horizon. That is very clear. The nearest rate cut, according to Bloomberg's World Interest Rate Probability in Chicago Mercantile Exchange, is going to be about 61% probability of odds. in June at the earliest. Inflation from tariffs are not fully understood, and that is something we've commented on early in the show and will be on episode 320 of the Higher Standard podcast. We will say how this is going to be a diabolical mess, and we did not see the long game coming. Lots of language on things appearing, but not committing to them. So that is basically my way of paraphrasing that. The FOMC said it seems like, it looks like. They have not said that the inflation market is under control. They have not said that jobs are stable and under control. They keep saying it looks like, it feels like, it may be like, and those are not definitive answers. Those are very politically maneuvered. I don't not like Jerome Powell. I think he's very good at his job. I have a great deal of respect for anybody who's under the scrutiny and pressure that he is under optically and from a human perspective. Certainly a tough press conference to come out. You had to know some of the stuff was going to get a little dicey in the questions, but absolutely well handled by him and the FOMC. I thought that entire press conference was good. I would point out that all of this ignores, and I'm surprised nobody brought it up, that what Amazon did today. And as Saeed in the chat already pointed this out, Amazon says, oh, you think the downside risk of employment is less now? Hold my beer. It was largely thought that Amazon was going to lay off 14,000 workers. Today, they announced 16,000 workers. There are some internal emails circulating as to what divisions those impacted, and we will cover those again on tonight's show. For those of you watching on Instagram, I love you. I appreciate you tuning in. There's been ups and downs and peaks and valleys in the viewership. A 2-hour-long show will do that. Again, the horizontal platforms, X, LinkedIn, and YouTube do tend to have a better presentation. And if you appreciate us doing this and you like what you see, go to joinfridays.com, enter code HIGHER. You'll get a discount. You'll support us. We love you and appreciate you. Go check out what they do there. It's pretty awesome. I'm actually signing up for myself. I'm going to switch over to them because all of you know that I'm on peptides currently, and I'm also on a GLP-1 microdosing, which they do offer. Until next time, everybody, I'm going to take the rest of the day off. I've had a long, fiery 2 hours, and I'm a little sassy. Okay, I know. Oh, I did promise a bit of a market recap before we go. We're still in a defensive hiding and safety. The U.S. market has not improved in response. It's been a relatively flat day. That should not come as a surprise to anybody. Synthetic volatility index not moving in a material way. I'll refresh this just to make sure that I'm not missing anything here. I think this is pretty much stagnant. Yeah, still 87. So again, nothing material changed here. Looks to be about the same. Fed liquidity position is going to be the same. This is pulled off of the Federal Reserve data. The sectors, we can spend a little bit of time here. I think this is actually worthwhile to look at. He was saying during the press conference that consumers are okay. Well, guess what? Every place that we consumers spend money is materially down today. That is a trend. It's not just Walmart or Target or Costco, Home Depot, or Dollar General. It's all of them are down, okay? Consumer spending is impacting the markets. And you could look at housing. Well, guess what? Housing sector modestly up today. Not a lot of, patterns there. You got JP Morgan, Bank of America, Wells Fargo. Banks are kind of mixed a little bit. Commercial real estate, refinance risk appears to be increasingly worse, not because of anything material that happened in the economy, because the rate market isn't improving and treasuries are rising. Mega caps are going to have an interesting day today. Remember, you got some of these guys reporting, including Meta, which is not on this, that is going to report today. Consumer, we already covered. Let's look at the industrials. The industrials are about a mixed day again. Flat. Energy, shockingly relatively up, except for one that's down. And I got to look into Schlumberger. Yeah, that's right. I said it right. Schlumberger down. I got to figure out why that's happening. I have not had the time because I've been on the conference with you kids taking a look at it. And last but not least, the defensive stocks seem to be, and these are the ones that capital preservation, you go into these because you're comfortable. They seem to be relatively stable at the end of the day. Not a lot here happening. Again, there is some conversation in healthcare, stuff like United Healthcare, stuff like that, that's been in the news. But we will cover that on tonight's show, 3:20 out next Tuesday. But thank you all for tuning in. I appreciate you being here. Until next time, everybody, as Saeed and I always say, okay, bye!